Ladies and gentlemen, thanks for calling in and joining us for another teleconsultation organized by the Asian Banker. This time we want to address the issue, can Asian banks lead the way in integration of risk and finance? This consultation is brought to you by the Risk and Regulation Working Group under the One Big Question agenda. This is a member-based program to help financial institutions track trends and identify leaders in the industry. This program delivers in-depth market and strategic research in the forms of individual bank profiling, research, interviews, case study, and so on. The One Big Question is a poll that is held as part of our effort to solve practical problems that bankers across the region are facing. In the lead up to the One Big Question, our team talked to industry experts and practitioners, and we will share these results with you shortly. We asked these questions of the bankers through an online poll. Have you achieved your desired level of integration between risk and finance function? Now, the last global financial crisis in 2007 has been described as a failure in risk management, and a lot of the executives in some of the big global banks were involved in major decision making about the risk that they were taking without really understanding what those risks involve. Now, as a result of that, there have been changes in bank regulation that emphasize the development and the inculcation of a more risk-conscious culture and environment. Prior to that, the financial reporting and risk reporting have traditionally been taken by different teams within financial institutions. Now, with some of the latest regulatory changes, this forced all levels in the banks to be more integrated to the risk function. But it has become apparent that in many cases, there still persists a silo culture that works against greater alignment between risk awareness and the finance function. Now, today we have a distinguished panel of presenters and speakers who will help shed more light on the alignment between the risk and finance function. Now, before I introduce them, let me just go through a bit of house rule in how you can participate in this teleconsultation. Now, for those of you who have called in to ask a question, you have two options. You can write your question into a chat box at the bottom right corner of your WebEx screen, or you can press the hand icon below the list of attendees in the right column of your screen. This will register your intention with us to speak, so we'll open the line for you. So even as we start with the presentation, please keep in mind the questions that you want to ask, and you can ask the question through those two means that I've just described. At this point, I would like to introduce the speakers in the panel today. First, we have Mr. Rajit Kanshi. Okay, Rajit is currently the founder and managing principal of operational risk management, a boutique consultancy specializing in regional BCM risk management as well as Islamic banking. Next, we have John Foley, who is a director of financial services analytics, who has 17 years of risk management. So both our speakers today are very experienced in the risk management area. But first up, we have Lovina Lim, research analyst with the Asian Banker, who will walk us through the result from our One Big Question. Can Asian banks lead the way for greater alignment between the finance and risk function? Let me hand the spot now to Lavina. Lavina?
Thank you, Wilting. My name is Lavina, and I will present an overview of the Asian Bankers research findings according to our One Big Question survey poll. As Wilting has mentioned earlier, the Asian Banker One Big Question is a debate held as part of our effort to solve practical problems that bankers across the region are facing. Bankers are encouraged to share key business issues, and a community-driven debate is organized to find a solution to these issues. Hence, all our debates are very problem-solving focused and close to the ground. Industry subject matters, experts are then invited to provide their views on the topic before we open up the floor for our audience to vote and share their views. At the close of the campaign, we will organize a teleconsultation session like this one to discuss our findings and conclude the campaign. To all bankers listening to this, if you have any issues you would like to see addressed and a One Big Question teleconsultation organized around it, feel free to drop us an email and we may very well organize it in our next One Big Question debate. Now, let us turn to our present One Big Question in the next slide. The question is, have you achieved your desired level of integration between the risk and finance function? And we have found that a little over 1/3 of the respondents in our online poll believe that they have achieved their desired level of integration between the risk and finance function, while 62% do not. This, however, is not purely reflective of the situation in Asia, as we have readers from throughout the world. We estimate that the majority of respondents from Asia answered no to this question. If you go to the next slide, you will see a few comments made from the bankers we surveyed, giving us an idea of some of the issues that banks are facing at the moment. The first one you can see is you need to come up with shared common definitions for data across functional departments. Without this, regulatory reporting is going to be a problem. This statement shows the need for standardized data definitions shared across the different functional silos. Regulatory requirements have become increasingly stringent over the years, and risk and finance traditionally speak very different languages. Hence, there is a need to align data, processes, and systems that support these processes, because if unaligned, reporting data to be sent to the central bank may not correspond due to the different data definitions. Information from both departments do not add up when they theoretically should add up due to differences in these definitions. The second comment is from a senior level representative of a domestic bank, expressing an important point regarding where Asian banks are presently in risk and finance integration. And with this, I pass the floor over to Boon Ping once again. Hello, Boon Ping.
Okay. Thanks, Lavina, for that overview of the results. Okay. Now, next, I'm going to again introduce Rajiv Panshi. Rajiv Panshi is the founder and managing principal of the Operational Risk Practice Private Limited. Rajiv, before you present your insights on the state of integration between the finance and the risk function, now how do you react to the response from the poll that close to 60% of respondents say that they haven't integrated? Now, given the regulatory changes and the increased emphasis on risk awareness and risk consciousness, would you expect that percentage of banks who have attained their desired level of integration to be higher?
Thanks, Boon Ping. I think if we look at those results in the context of, I mean, I'm making the assumption that those results reflect the views of Asian banks. If that is the case, the question that I have is that what was the destination state that people had in mind when they were making a judgment about the current state of the achievement of the desired level of integration. That was one of the things that I thought may be helpful for everyone. And as I sort of walk you through, my perspective in terms of how I see this, the whole topic of risk and finance integration panning out. So if I can just take you to slide 3. Now, the obvious question is, why is this suddenly getting so much visibility, and why now? And the imperative is really coming from the uncertainty in the operating environment and the current challenges faced by banks. And a lot of this stems from the post-financial crisis, but it's always helpful to just sort of take a step back and ask ourselves what were some of the lessons coming out from the financial crisis as we start thinking about how to drive change in a way that positions banks to be better prepared to respond to uncertainties in the operating environment. So can we move to slide 4, please? Yeah. So if you just sort of step back and really look at some of the key lessons coming out from the crisis, I'm not going to go through each one of them, but just a couple of key points out here. Clearly, the whole approach to risk was very, very siloed. And part of the problem was, the way the organization structures, the communication was working and designed to work, and also the way, the whole language around risk was structured, which sort of didn't allow for a common understanding of how risk should be looked at in a more holistic manner. While in theory there was a lot of rhetoric around risk reward, the reality is that the focus was very, very short term and driven by a very strong non-ethical desire to beef up compensation for wherever there was a direct link to revenue generation. The reality is also that there were a lot of failures at a strategic level, and when you look at the kind of the governance process failures, the errors in reporting, the failure to respond appropriately when limits were breached, or risk tolerance limits were breached, and the compliance breaches, you have to ask, how did these failures continue to happen at the senior level? So there is a strategic and there is an execution level perspective that one needs to take when you start looking at some of the lessons. And of course, then you also have the issue of the inability to aggregate information across risk and finance and understand the true strength of the exposures. What this all really sort of contributed to was the inability of banks to understand the implications of uncertain events on business performance and to be able to respond appropriately in a timely manner to take the right mitigation action. If I take you to slide 5, when you look at it in the Asian context, there are some similar issues still outstanding in Asia. But the CRO concept is still evolving, so the holistic risk approach is not to where one should have it. The risk language is still very, very weak. There is a delinkage between risk and finance. The key point to note out here is that with the relatively lower fallout coming from the crisis, you could see an element of complacency emerging within the Asian banking setup, which would progressively lead to people shying away from making the necessary investments to beef up infrastructures, drive the necessary changes to secure firms to operate in this sort of an uncertain and challenging operating environment. So slide 6 really focuses attention on what's the need for the what do we need right now, and some of the essential changes include a renewed focus on understanding how banks can gain by optimizing risk reward better for the business. Risk reward is used very loosely, but in reality, the linking between risk and understanding the implications on performance is not necessarily fully assessed at the time when strategic and operational decisions are being taken. And there needs to be greater focus on structure, source, and use of relevant data to drive risk reward. And this has to be embedded. The understanding of risk reward has to be embedded across all operating levels within a particular business. This is not a conversation only for top management. You also need to have it at the process level where a lot of the operational decisions are taken, and that's where actually risk arises in a number of instances. At the heart is really the need to integrate risk and performance data in a manner that provides credible and reliable view of risk and the implications of the same on overall bank performance. So I've talked about the need and the imperative to look at risk and finance in a more sort of integrated way. But we also need to be realistic. The first thing is what is the outcome that we're really seeking? So what does change actually look like? What will change actually look like if a bank were to say that it has successfully integrated risk and finance? And just a couple of bullets that may help towards that understanding. The first is risk is considered in a more holistic sense and an integral part of the strategic planning process. So risks are properly assessed as part of strategic decisions. There is greater clarity on risk appetite and tolerance, and this is a progressive evolution. Risk assessments are factored in appropriately into new business approval decisions, including product programs, strategic change initiatives. Whenever you're driving a major change initiative, a major change project, infrastructure or non-infrastructure related, and also during M&A. There is also the understanding of how risk can influence performance and reward must permeate all levels of the organization of the business. This would then drive a fit-for-purpose response and efficient allocation and utilization of scarce resources, including capital. Risk silos should pave way for holistic risk management with a focus on business, culture, integrated MI, robust controls, and a strong view on emerging risks. The standardized and integrated data model should then allow for more aligned risk and financial reporting and help save considerable wastage of time, effort, and resources who are today dedicated to try and reconcile numbers coming out from two different solutions. And of course, then you have reward for managers is linked to risk and performance from a longer term perspective, which then also takes us into the whole compensation conversation. Slide 9 really talks about some of the challenges. So you will hear in the subsequent session, and also I've illustrated some of the key challenges out here. And each challenge has a risk, and it's important that the risk be understood and understood to the extent that you need to appreciate what implications this would have on the desired end state if you were to look at integrating risk and finance in a more successful manner within your respective organizations. So if you were to sort of move forward in some real practical steps, the first thing that I would recommend is you articulate the destination model and what change would look like. Once you have that buy-in, it's important to get the board approval and sponsorship of it, because this is a significant change. It impacts the way governance and other processes are driven within the organization. It drives accountability, it drives authority, and it is very, very important that this is seen to be driven right from the very top. There needs to be a very clear definition of risk types with tight boundaries and clarity on the overall taxonomy between risk and finance, so everyone speaks and hears a common language. Articulation of risk appetite and tolerance is very, very important, but it needs to be as part of an end-to-end framework, not just something that is seen to be a very high-level boardroom concept, but something that transcends into the very core of the business process, where a lot of operational and strategic decisions come to play. Integrating risk assessment into the strategic planning process, I touched upon that earlier, but importantly, from a business as usual, from an emerging risk and a stress situation. That's important. We must be able to understand in today's uncertain environment what specific uncertain events would look like and how would they impact performance. And one way to start looking at that is to start integrating or linking the way we look at risk indicators with performance indicators. Importantly, as you go through this process, it's important to ensure that your risk management capabilities are aligned to deliver the appropriate performance being sought the business. This is how you start contributing towards sustainable, ensuring that business growth is sustainable. And this is what actually starts moving risk to be a right partner for the business. And of course, as you go through this in a sort of a cyclical manner, you keep enhancing your understanding and perspective of risk appetite. Sorry, I moved on to slide 10 and we're now moving to slide 11. There is a prize at the end of this, and the prize is in the form of enhanced risk and performance culture, efficient and effective deployment of resources, shareholder value creation through sustainable growth and better management of earnings volatility, more secure credit rating that gives people, investors, and other stakeholders confidence, forward-looking anticipatory risk and performance management with focus on business as usual risk and also emerging uncertain scenarios, ability to spot and seize right opportunities through timely and credible risk reward assessment, and capital optimization. These are some of the prizes. So, in light of this, what I would say is, if you were to go back and do a repoll and revisit some of the findings in terms of how many people really believe that they have achieved the desired outcome from the integration of risk and finance, it will be interesting to see if there's any change. Thank you.
Ranjit, thanks for the presentation. Very insightful. You go from the needs to understanding the context today and painting the destination point for where the alignment should be going. Now, in your work with banks in the region, in the Asian context, now identifying that destination model. Where are some of the banks now in this regard, in that process, and what are some of the big challenges that they face? Where do you see them making early success, and where will the pitfalls be, you see?
I think if you look at slide 5. I mean, what I've attempted to do out there is really sort of give you a perspective of where I see some of the Asian banks as of today through some of the conversations that we've had. The worrying thing for me is that if you look at the lessons coming out from the crisis and some of the factors that I've pointed out there, a lot of these are core operational failures. But the realization of this hasn't necessarily crept in and fully been appreciated across organizations. That is worrying for me, and the lack of appreciation that at the core of some of these failures were the operational flaws, breakdown of some very basic controls. Takes away the focus on the need for certain investments that are absolutely necessary to make sure that we focus on investing in risk in a more holistic way rather than just looking at the risks which have a more direct relation to revenue generation. So I think that is something that is very key. And I sometimes refer to that slide which I say lessons from the crisis and end it by saying that's operational risk for you, because there's a difference between the theory and the practical realization of what an operational failure or event could sort of imply in real life. I also see the siloed risk culture still existent, although with the emergence of the CRO role progressively across local and regional banks, you are beginning to see efforts to bring together risk in a more sort of integrated way, but there is clearly a fair bit to go before banks can feel comfortable that they are where they need to be. There is still a reactive approach to risk management, driven with a very strong focus on what people believe to be known historical events. The focus on emerging risks is not that high at this point in time. The area of concern for me is that with the plethora of uncoordinated regulations that are headed our way, there continues to be a compliance-led risk management focus rather than a business sustainable risk management focus and culture that should be evolving and developing, which at the minimum meets the compliance requirements. That's going to be very, very critical to make sure that if we are to achieve the intent of what we really want to deliver through a risk and finance integration. And of course, making sure that the whole concept of risk reward gets embedded at every level of the organization. I don't see that happening at Asian banks. I mean, if a good test of that would be to see how many risk managers, particularly operational risk managers, are involved in strategic planning discussions upfront at the business with the business head. It's there in some of the larger organizations, the more advanced firms, but in some of the local and a lot of the local and regional banks, that's we are not there as yet. It's very reactive.
Okay, Roger, interesting. You said a lot of the response is still reactive, very compliance-led, and that there is still a lack of appreciation for some of the operational risk impact or the risk rewards being embedded across different business units. Where do you see as the root cause? Is it the senior management board not really understanding the implication, or as you said, more because of the culture?
I think I wouldn't say there's a single root cause for this. I think there's a couple of things that need to happen. I think if you talk to board members today who are typically sponsors of any major strategic change within an organization, on their list of things to worry about would be at least one or two operational risk events. You can take that for granted. It's there on everyone's mind. The challenge is, unless you've suffered a big loss or unless there is a compelling regulatory requirement, the board and senior management do not get pushed enough to say, I recognize the importance of this, I recognize the implication it can have for other risks and for my business overall, and I'm willing to, I know I need to make the right investments up to this level to make sure that we secure our business. That kind of thinking is not that prevalent as yet, unless you have a senior management that is fairly advanced in their thinking, fairly mature, have been through downturns, have been through serious problems where you have different risk types interplaying and impacting the business. You don't see that happening to a level that you would like to see it where it ultimately results in the right level of sponsorship for a more holistic risk focus. Bunping, are you there?
Hello, Bunting. Let us move on to Mr. John Fowley. Mr. John, would you like to begin your presentation now?
Sure. Thank you very much for having us this afternoon, and thank you to the Asian banker for this insightful and provocative question. Bunping actually asked the question as to whether there was any surprise in the response. And the only surprise I have is that 35% of the respondents are actually stating that they've achieved their expected alignment of risk and finance, because that is very, very different from the reality I see on the ground. And I'm having these sorts of conversation with customers on a daily basis. And we are very, very far from having achieved some level of alignment in definition, in usage data, in technology to ensure the alignment of risk and finance. So what I'm going to be doing this afternoon is to actually talk to you about the different obstacles that we have leading to that integration. And one of the US initiatives which is going to some way to address and force that integration. So when we look at the alignment between risk and finance, I think regulation has probably been the biggest driver. And we see many common usage of data across the definition of risk and function. We see loan loss provisioning, we see stress testing and capital planning. And here what I mean by stress testing and capital planning is not just the exercise of performing a stress test and looking at the impact in terms of risk, but looking and translating that risk impact into an impact to my income statement and balance sheet. Risk-adjusted performance measurement, as well as liquidity risk management. What we see is really the distance relationship that seemed to have existed 5 years ago between risk and finance somehow dissolving. And we need obviously to work a lot closer together between risk and finance in order to reap some of the benefits that are being promoted by the regulator for a more sustainable banking. So we are involved with customers all over APAC and around the world, obviously. And some of the findings are quite interesting. I'm talking to a bank right now in Australia, which is really looking at their risk-adjusted performance measurement as a driver of competitive pricing and to ensure an alignment. So risk-adjusted performance measurement is the perfect example where part of the matrix is actually going to come from finance with profitability numbers and activity-based costing fitting into the profitability and finance number, and the risk usually taken in the matrix of economic capital as the impact of any activity generated by the bank. So we're seeing an alignment that is driving this these projects, and obviously, if I'm successful in delivering these initiatives, I can see an impact in terms of risk and finance. So if you go to slide 4, you will see that obviously we have data. As one of the biggest problems. And whether it's risk or finance, 80% of the problems that we are faced with are data related. But data is not the only option and is not the only problem that we face. We have two different cultures, two different functions that have two very different objectives. And one of the difficulties we face as the regulator is driving a lot more of these initiatives that are at the cornerstone of risk and finance is specialists within the banking organization that are able to understand the finance view and the risk view. And one of the most original way to address this problem is to create a team of cross-function specialists. And I'm aware of some banks that have actually dedicated some members of the finance team to work and be delegated in the risk space for a given number of months, and some risk specialists to go and work in finance. So obviously, not only do we need to have an underlying technology that allows us to have a single repository and definition for risk and finance, taxonomy, but also people and processes. And that doesn't happen overnight, and it certainly doesn't happen if we only consider the technology aspects. We obviously need to invest quite significantly in ensuring that we have similar culture and knowledge on both sides of the risk and finance divide. So one example I've chosen today is come from the US and is really interesting in terms of where the regulation is going and what is the impact on the risk and finance initiative. You might be familiar with the Comprehensive Capital Analysis and Review program, which is called CCAR. And if you read the Financial Times or Wall Street Journal, you will see mentions of that program under the Federal Reserve stress testing. And what we see in this context is the requirement for banks to perform stress tests and reproduce or recalculate and provision their loss as a result of a stress test into a new income statement and balance sheet. So prior to that initiative, stress testing used to be a very risk discipline. And we had something in Basel II, Pillar 2, ICAP, which tells us that, well, the results of the risk report need to be interested in capital planning, but somehow it's not fleshed out in a very prescriptive manner as to what exactly needs to happen. Here, we have a very specific framework that allows banks to look at the impact from the risk perspective, do the provision, do the loss, accounts for this, and see what happened in terms of income statement and balance sheet 9 quarters away. And as you're probably aware, banks that are not able to achieve the 7% Tier 1 capital at the end of the 9th quarter are not able to do what it is that they want to do with their capital, corporate actions, and specifically raising dividends. So if you've read the press of the past 3 months, you'll be aware that JP Morgan successfully passed that stress test and was able to return money to shareholders in the form of dividends, while at the same time Citibank was trying to increase its dividend payout and wasn't able to do so because it had not satisfied the result of the CCAR. So what sort of scenario is the regulator prescribing? Unemployment rate of 13%, 50% in equity price, and 21% decline in housing price. Based on these scenarios, considering the impacts over time, because this is not just a point in time, but more of a through the cycle type of view, we need to look at the income statement, we need to look at the balance sheet, and really integrate these two different dimensions. Ultimately, the biggest problem that we face is really the inadequacy of silo view, both on the risk and the finance side. Just to give you a couple of metrics, one of the banks I've met, which is about 500 billion US in assets, the risk technology, risk architecture has a total of 110 different risk systems. And here's a problem fundamental to risk, which is consistency and definition. When I look at an interest rate swap, a 3-year swap, and I define a stress test, if I have to replicate that stress test across 110 systems, I will see that the construction of the yield curve, I will see that the movement, the interest rate models are going to be different. And at a later point, I'm going to do an aggregation of these results, but the underlying methodologies are not the same. And this is only when we look and consider the risk universe. Obviously, when we start looking at finance and the way finance look at these numbers and the way finance do its own calculation, we obviously have a greater degree of stress. So we obviously need to do an increased focus on capital planning and implement that joint technology. And in order to do this, we need data layer, which is going to be a single repository for risk and finance data. There will always be dimensions which will be specific to finance and dimensions which will be specific to risk. But in both cases, we will want to have a single repository for the data for analytical purpose. The second aspect is really capital planning and taking this to not just a pure compliance exercise, but embedding that risk and finance initiative as part of the capital planning of the organization. And really the third aspect is not just looking at the technology, which is somehow a simpler aspect to address, but also consider the business process implication as well as the skill set in the organization to enable us to deliver this. Now I've filled my 8 minutes, so I'm happy to take any questions you might have.
Okay, John Bunping here. I got disconnected for a while, so I missed the early part of your presentation. But the later part, I just want to kind of get your perspective on what are the challenges that Asian banks face. You mentioned about skill sets and about processes. Currently, the finance and risk process and structure are quite independent of each other. What do you see that, especially the local banks in the region, need to do to overcome some of these challenges?
Well, I think the first thing is the realization of a risk as a discipline that can create value. And I think in many countries in Asia, risk is synonymous to compliance. And obviously, this is not going to carry the right level of weight in the organization in order to be able to do what needs to be done. So very often, and I'm talking about the emerging economies, we see the risk function really taking a backseat, more of a compliance, not driving strategic decision. And obviously, this needs to change, and we're involved in information and training at board levels to really establish the value of risk in the organization so that we have a more balanced dialogue and we really understand what risk can do. And I think risk managers themselves need to ask what is their contribution to the business. What I would want is to change the function of risk management from people who say no to people who say we cannot do on the basis of the structure that you're putting forward, but if you were to do this, then you would meet our risk appetite and performance profile. Therefore, we would accept. So becoming a partner from the business, not just the people who can say no, but the people who can say yes and provide different solutions when we're facing with a competitive situation.
Now, to both John and Ranjit, right? So do you see this as a mindset issue? Now, Ranjit mentioned that from the last global financial crisis, Asian banks are relatively unscathed from that experience. They have put in proper capital control, manage their capital requirements, and are well capitalized. Do you see that as giving ground to complacency? Maybe this perception that we are conservative, we are risk adverse. So as far as the Asian banks are concerned, and in a certain to the certain extent, we already comply to regulations and we are meeting those regulations.
Yeah, I think you, and I'll start answering, and Ranjit can complement my answers. I think the Asian financial crisis was an opportunity in the sense that bank really became extremely worried and understood the consequences of a very simple event in Thailand, leading to an almost complete meltdown across the region. As a result, banks have been overly conservative, and you see in Singapore or anywhere in the region level of tier 1 capitals that do not exist in the US or in Europe. However, this comes at a cost. This comes at a cost in terms of return on asset, return on equity. and many missed opportunities. I think today the opportunities for banks in Asia to take a leading role in economies. We've seen the large European banks, the large American banks withdrawing somehow and reducing their activity and the scales of their presence in Asia simply in an effort to preserve capital. This is an opportunity for Asian banks to step into the breach and be a bit more aggressive and capitalize on that excess capital to grow the business. Rajit?
Yeah, look, I think we've talked about the crisis, and it's important to take the lessons in context. One of the things that comes out very, very clearly when you look at the banks that got impacted and the fallout from the whole crisis, it's very clear that a number of those organizations, everyone talks about too big to fail. I like to think about it as too big to manage, right? And I think a lot of those organizations that suffered had reached a stage where it was just too big to manage, and for the board to be in a position to say that they were on top of every single issue or risk that was material enough to the company. It was a different thing that in some cases the right questions were not even being asked. I think in Asian banks the circumstances are slightly different. They are smaller in size, they are less complex, and therefore they are better positioned to seize the opportunity for driving some of these changes. Because they've been relatively, they've been impacted to a lower degree, they are less distracted. So the fundamental thing that therefore needs to move the Asian banks in the right direction is really the top level sponsorship and mindset change, which then has to start permeating through every level of the organization across the business to get people to understand what risk reward optimization really means at a both strategic and then execution level. And that's a cultural and a mindset change, and it's not going to happen overnight. The journey needs to start now, and it needs to be supported by appropriate data and infrastructure integration on the back of a very, very clearly defined language and taxonomy.
Okay, I'd just like to remind all callers, if you have questions for John or Rajit, please indicate your interest or send us your question. Now, Rajit, from your perspective, from an operational risk angle, today a lot of what the risk managers are doing regulation driven, compliance driven. Now on a strategic level, what can they start doing to get this culture and mindset change going? Do you see processes and skill sets as an area that they should be working on?
I think as a key mentioned, the starting point has to be right from the top, because the way the board looks at risk and the way the board drives how risk and business and finance need to work together needs to be reviewed and more clearly articulated. That then needs to flow down in the form of very clear sponsorship, defined authorities and accountabilities. Once you have clarity on that, and there's greater understanding and appreciation of risk appetite and tolerance, and how an understanding of risk can influence performance, what becomes very, very important is to step back and say, do I have the right people? Because in the scheme of things going forward, the risk manager must be someone who should be able to walk up to a business and say, look, this is not working in the interest of the organization. The short-term gain may expose us from a longer-term point of view. We need to start thinking of putting some constraints if this problem is not sorted out in a reasonable time frame. He's someone who has to be able to have that conversation and be willing to escalate it if need be. The question is, how many risk managers do you have today who are positioned to do that, or who feel mandated to do that? I think the second thing is that historically, the risk managers have operated in their traditional silos. Going forward, if you are ready to achieve the intent behind what is being spoken about, you have to look at risk across all the different organization structures. So how does operational risk get looked at at the front end? How does operational risk get looked at in the credit risk areas, in the market risk areas, in the liquidity risk areas? Who's responsible for that? Who covers that? I'm just using operational risk as an example to get you to understand the change in scope if we are to start thinking about achieving the intent of what we're really trying to sort of move forward. So I think skill sets and profiles that certainly need to be reviewed, but on the back of certain other changes that need to be driven with a very, very clear top-down sponsorship. And then when you take it down to the actual business process level, you need to start looking at risk in a more integrated way, because one of the lessons that came out from the crisis was risk morphs as you go through the end-to-end process. And the ability of the risk manager to spot where an operational risk could change into a credit risk or a liquidity risk is very, very important. If you have a risk manager just thinking and operating within his blended silo, you are not going to be able to spot that morphing in a timely manner. And that becomes very, very critical. And again, you have to look at it in the context of the, the entire business.
Okay, John, anything you would like to add from your perspective in this regard?
I think one of the interesting aspects and how we can really change the culture is by aligning the compensation. The brightest in organization, in banking organization, would tend to go for front office type of position, financial markets. And you would typically celebrate if you get promoted from back office to front office. And so we have quite a number of examples with Jérôme Kerviel and the latest trader from UBS to state that having people who have a deep understanding of the operation is probably not a very good idea for promotion into a front office system. But we never celebrate when anyone is promoted from or change from front office to the world of risk. Yet it is very important that the people who work in risk be as smart and as knowledgeable and have understanding of the financial market to the same extent of the people that they're controlling. Unfortunately, that's very rarely the case. And what we need to do is to align the compensation structure to the most complex aspect of the market to ensure that the best and brightest choose to work in risk management, and it is not seen as the dead end or a pure compliance function that is disposable.
Okay, very interesting. In terms of from a compensation perspective, but in that regard, now the risk function is seen as as you said, as a control compliance function. So what you're saying is that there is more that they can do to integrate what they do with the business, not in terms of just compliance, but in terms of increased profitability, and that can be reflected in increased compensation. How do you see it working, John?
So yes, but we need first to address the change in mindset. So the risk management has to change from being the people who can say no to the people who will say yes under certain conditions. And it's really a partnership. But in order to be able to do this, there's a lot of work that needs to be done in breaking down the silo and understanding and having the capabilities to stress test and come up with suggestions as to how a given transaction can actually be structured in order to meet the risk appetite and profitability profile of the bank. So these are elements that needs to be taken into consideration. There should be sets of metrics that are common and objectives that are common, and RAPM is probably the best way to do this, so that a given level of risk is compensated by the adequate level of profit. And very often that is what is driving this this initiative to a successful completion.
You earlier mentioned the need for cross-functional risk specialists that works within finance and business. How do you see that translating in practical terms to the Asian banks?
Oh, I've mentioned, and the example that I mentioned was actually from a bank in Singapore, where a dedicated team from finance were actually delegated for a given period of time of several months and embedded into the risk function, and some of the risk people were actually embedded into the finance function. So the cross-pollination of talents and knowledge is not going to happen unless you take people from their area of expertise out to a department that allows them to gain that exposure and an understanding of what the other guys are doing on the other side of the fence. So it needs to be very deliberate and strategic in how we do this, and these cross-functional team and placement, internal placements are actually good ways to achieve that that knowledge and that synergy.
Okay, great. Thanks, John, for that insight. Now, at this point, let me summarize some of the gist of what we've discussed today. We talked about the importance of having a destination model for the role of risk and risk manager in the organization. Today, the risk function, the role is very compliance driven to meet regulatory requirements. We spoke about the need to have a mindset change in terms of the role being a more strategic one, where it is embedded across functions. From the poll results, we know that banks in Asia is still some distance away from having that desired level of integration between the two functions. Now, we also talked about opportunities, especially for Asian banks, to do more in this area, especially when they are in a relatively strong position. They are well capitalized, fairly conservative. John spoke about how Asian banks can probably be more aggressive here in terms of aligning risk and the finance function, and in fact across the different business functions. Now, on that note, I'll just turn to Rajit and John if you have any final comments before we end today's session.
No, I mean, all I would just say in conclusion is that look, I think it's important to be very, very clear as to what is the desired outcome when you embark on an initiative like this, because you know, this is a journey. It's a cultural and a mindset change, and we need to be very, very realistic about the expectations and what we are trying to achieve, and the downsides of not recognizing the reality to move down in this direction.
Okay, great, Rajit. John?
I think I'll go back to one point that Rajit made, which was that this initiative needs to be driven from the very top of the organization. Risk and finance on their own are not going to come up with changes to the strategy, alignment of KPI, performance, in order to make these happen. So there needs to be a very clear mandate from the board, and the board needs to understand. So we participate in that training, discussion, educational process in order to ensure that we get the right level of understanding at the board to drive this initiative effectively across organizations.
Okay, thanks, John, for that. Thanks both to our speakers, Rajit and John, for their contribution and their insight. Now, as they mentioned, this alignment of risk and finance and the end destination for where this is heading. This is only part of a journey, and now banks have to be very clear what they want to do, and this has to be done from top down. And this is an area that the Asian banker will continue to focus and update our colleagues in the industry on. So on that note, we'd like to thank both Rajit, John, as well as Lavina for their part in this teleconsultation. Now, the proceedings from today's session will be posted on the Asian Banker shortly. So until the next teleconsultation, we hope all callers a good day. So on that note, I would like to thank all.